of mute. So before we jump into the actual lending side of this, I see some names. I know a lot of people that have jumped on the call registered here. Some names I'm not familiar with, so I do want to just quick approach, kind of let you know who I am and why, we can give this perspective on the NAR settlement itself. So if you haven't worked with us, all the contact information is there. So I got my undergrad degree, went on, got my MBA. I concentrated in finance. I'm the nerd behind the scenes where I like the numbers, right? We're analytical. We're the same way every time. If you've worked with us, you know that. You've seen that either from the listing side or the buyer side. What we do is really make that customer experience the top priority. All of our contact info, some of the information from our presentation today is going to be there on our website as well. If you want to scan that, I'll put that up at the end too. But look, don't just take my word for it. I can stand up here and talk good about myself all day, but what we focus on, we put a lot of weight on customer feedback, customer reviews, and the reviews, they don't lie, right? So go to Google, go to our website, you'll see all of this, but people have good things to say about us, and I feel like there's a lot of weight behind that. So what I want to do is actually recap, if you were on our last session, where we talked everything surrounding the NAR settlement, not the particular legal aspect to it, but everything else. So what I want to do is just touch on that real quick, and then we're going to get into the lending side of all this. Now, if you weren't part of that, this is really what we went over: the mindset, the process, the particular contracts, and the conversations. So if you remember the mindset, that's really where we have got to tackle this head on. Don't be scared. Don't be afraid to go ahead and dive into this. Don't wait is really the message that we portrayed at the last event. And because it is what it is, right? We say that about the market. The market is what it is. We're not changing it. We're not changing what's coming our way with this NAR settlement. So we just have to act on it. Let's stay proactive there. So the next was the process, right? Knowing how you're going to confront this with both sellers and buyers in the market, and what your value proposition is, how you're going to propose that to them, the contracts where you're going to get with your broker for what language I'll have in your buyer broker agreements, and then the conversation surrounding that with the clients. So I do want to check, we're going to use the chat a good bit if you can't tell, who from the last call took the action, went ahead and started putting together or built out your value proposition. I want to see a raise of hands. I want to see who's taken that initiative. I hope it's more than one person.
Are we able to ask a question, or?
You can. I'm going to ask if you can hold most of them until the end.
Well, okay, really quickly. Did I need to be on a previous call for this to be beneficial?
Not at all.
Okay.
So basically what we went over on the last call with the value proposition is actually building that out. There's this whole Hermosi model. There's a book behind it, a strategy there of how to build out your value proposition. If you didn't get the recording or see that on our YouTube channel or anything there, look that up or shoot me an email, shoot me a text. I can send you a link to that. A lot of good information there as far as putting your value proposition together, but then also being able to show that to a client. So next thing was just following up from our last on open houses and having that follow-up plan in place. We expect open houses to almost be a loophole here where buyers don't have to have that buyer's agent agreement. They can walk into an open house unrepresented. They always could, right? It's not like that's changing, but that's where we can absolutely help pick up some business with any listings, or if you're hosting an open house for somebody else, making sure you have a follow-up plan there in place. Those are just two of the big things we talked about last week. So let's dive in. Everything lending, okay? So what we're really going to be going over all things mortgage, all things financing. We're going to go over some loan breakdowns, some specifics, some numbers, how we make things work. That feel like that's the meat and potatoes of this, right? But then we're also going to touch on seller concessions or the seller credits. I want to make sure y'all know the differences between different loan programs and different ways, different limits on those seller concessions. We get that question a lot anyways. And then the last, we're going to underwriting guideline changes. So we're going to go backwards here, and we're going to start with the underwriting guideline changes. So what this is basically our three main loan options that we see more than anything else, your conventional, your VA, your FHA. They've all come out and addressed this. How much they addressed it is kind of comical, but these are the changes that they're implementing. Now for conventional loans, let's start there. They came out with a statement, this is back in April, where they basically just pointed out that, hey, you still have your seller concessions, your limits there, anything from 2% to 9% of the property value. That can go towards anything that's customarily paid by the property seller. Their stance is that commissions are still customarily paid by the seller, and those limits are there to be able to cover that. Now, the seller concessions, if it's customary, which it is in our market, for the seller paying buyer's agent and that not being a part of the seller concession limits, the credits, then that's still the case. So you still have, like on conventional, that typical 3% seller credit to go towards closing cost and prepaids, and then commissions be separate from that. FHA, let's jump to that. Very similar. They came out and said, hey, look, we acknowledge this. Nothing's changing from our side as far as underwriting. You still have your 6% seller credit, and they left it at that. They came out with that way back in March. Now, VA is the one that has stepped up their game. What they have come out and told us is that previously the veteran was not allowed to pay those buyer agent commissions. Well, they have changed that. They have updated that in their guidelines. They acknowledge that in order to remain competitive with the VA loan, with an offer going in on a house, that needs to be an option for their veterans to be able to pay those buyer agent commissions. So they've changed their underwriting guidelines to be able to allow just that. Now, a side note on VA, if you do a lot of VA business, if you work with veterans buying or selling properties, no, there's a difference in lenders when you work in VA. We specialize in VA loans. You know, I travel at least once a year. We have a whole committee, a whole group of veteran mortgage advisors is what we call it, where you've got all the details, the like the tricks of the trade as far as VA loans go, whether it's initiating tidewater on the appraisal or rebutting a inspection from the appraisal, all the things like that. It's just something good. Have somebody in your corner when you're working with a VA client that knows, that does VA loans every day, not somebody that does them twice a year. Okay. So on the same topic, seller concessions. I went ahead, I broke down the different limits for our big three loans. The scan here, this is going to take you to, it's our link tree. There's a flyer in there that breaks all of this down. It is a great cheat sheet when you're working with a buyer or working with a listing and you're wondering what that seller credit limit is. So that cheat sheet is right there ready to go. Now, what we do on conventional loans, everybody is aware of the 3% limit on seller credits for conventional loans. Know that that's anything for a 10% down payment or less, okay? So if you're putting more than 10% down on a conventional loan, the seller credit allowed is actually higher. If you look on this with 25% or more down on a conventional loan, that seller credit limit is up to 9%, okay? Not a lot of people are aware of that. There are cases where you can get a lot of things covered. Think what 9% is on a sales price and what you can cover there. And then investment properties, you're limited at 2% seller concessions on conventional loans. VA, they have that 4% credit limit. but we're unlimited on closing costs. It's a caveat to those VA loans. So think that's anything as far as like you can pay off a veteran's credit card balances or judgments or pay for that funding fee with VA. All those types of things where there is no limit to what the seller can do. And then lastly, the one everybody knows about with FHA.
Okay.
Let me go and mute everybody real quick. Last one with FHA, where,
Look how plunges go all. Huh?
Find this one for downstairs.
sorry, I'm getting thrown off here. All right, I think we're good. Last one with FHA and that 6% seller credit limit there. So like I said, easy cheat sheet there. If you haven't scanned that to get that, that's super easy to do. So let's start talking some numbers as far as loan scenarios and how we make this work. I feel like this is what everybody wants to see. So what we have here is I went ahead, I did a 600,000 purchase price. I did this for Mattery just to run numbers with property taxes, insurance. You'll also notice, so this is back from a little over a month ago. Rates are not 6.99 right now. I just left it there for that, for example, right? So what we have is covering the commission gap, right? First column here is just your standard 600,000 purchase and what it would look like. Monthly payments, 4,264. This is with 20% down. Monthly payments, 4,264. Cash to close, about 142,000. Okay. Now the second column here is if no commissions were covered by the seller, and probably the easiest option here is having that buyer just bring the additional cash to closing to pay a full 3% buyer's agent commission. So you'll notice your cash to close is going up about 18,000 from your original because they're just simply bringing the extra cash to closing. We realize not everybody can bring an extra 3% to closing on a house. So what we can do here is the other easy solution, building in that commission to the sales price of the property itself. Everybody's aware of that. Everybody knows that that's an option. And what that does, you increase the sales price. It's still 20% down, so your loan amount is going to be a little higher. Your monthly payment here, it only goes up $114 for an extra 18,000, financing in those commissions, $114 on a $600,000 purchase. Not a lot of money per month there. And the other big thing to note, your cash to close does not go up exponentially by increasing that sales price. It's 20% down on a higher amount, which is where that higher cash to close comes from. But again, an easy solution, you're looking at 4,000 more cash to close instead of 18,000 more cash to close. Okay. Now I know what everybody's thinking is, well, the property was 600,000. We're now buying it for 618. We're going to have appraisal issues, or what if the appraisal comes in low, right? Well, there are strategies in place to be able to work with that. So what we can do with an appraisal gap is say the appraisal comes in right back at that 600,000 purchase, right? What we'll do, we'll keep the loan amount the same, okay? We can protect that interest rate that they were getting with the 20% down. And what that'll do is that will not change their monthly payment. The way that we'll do this, you're now putting less than 20% down. We're adjusting the down payment in this scenario. What we'll do, it's called a single premium mortgage insurance. If you haven't heard of that, it's a very valid thing. It's something we can do on any loan where instead of paying monthly on your mortgage insurance, anytime you put less than 20% down, you can do, it's called a single premium mortgage insurance where you're paying, in this case, what is it? It's $1,500 on a $600,000 purchase. No mortgage insurance in your monthly payment. So your monthly payment stays the same. And we were working in the 18,000, the 3% commissions. We're still working that in. And look, their cash to close only goes up $1,500. So that's a win when we're talking about getting a low appraisal or having to cover an appraisal gap there. Hope that makes sense to everybody. I think the biggest thing to note is that the monthly payments do not change a lot. Neither does your total cash to close from the buyer side when we work in those commissions, and even if the appraisal comes in low. Next one here is we're going to go over a couple of different scenarios of, say the seller is offering a 2% commission towards buyer's agent, okay? In this case, what we look at, so I'll change the numbers just to keep it interesting. On a $400,000 purchase, again, I did this with Metairie numbers. Seller is contributing 2% to the buyer's agent. This is just plain vanilla what it would look like. Monthly payment on a 30-year fixed rate loan, you're looking at $2,831. Again, 20% down payment here. We're going to touch on that. Cash to close about $94,000. So what we all consider reasonable, that 3% buyer's agent commission. That's what we're looking for, right? You can settle on the 2% or you sign that buyer's agent agreement at 3%. Well, here's how we make it happen. So you have a 1% difference there of what the buyer has to come up with. Easy solution, have them bring that additional cash to close, right? Not everybody can bring that additional cash to the closing to outright pay for that additional commission. So what you can look at doing, let's add in that 1% to the sales price. Loan amount's going to go up a little bit. Monthly payment in this situation goes up $25 a month, okay? Nominal. Cash to close goes up $800 a month, $800 total by working in that $4,000 commission. So this is getting you to that full 3%. Now, again, if the appraisal comes in back at that original sales price, that 400, there's a strategy for that. There is what we do, it's a single premium mortgage insurance, keeping the loan amount the same, and monthly payment is $25 more. It's about $1,000 more for the cost of that single premium MI instead of having it in the monthly payments. So from the buyer's perspective, their monthly payment is staying the same as if they were to have offered an extra $4,000 on the house, working that into the sales price, and their cash to close goes up about $1,000. So that's getting an extra 1% added into the scenario. Next one, the next one is going to be seller pays 1% buyer's agent commission. We'll fly through this one pretty quick. 20% down, same thing. $2,831 monthly payment, $94,000 cash to close. Well, buyer's agent, we want 3% commissions, right? So we need to work in that extra 2%. The seller's only offering 1%. Again, easiest thing, bring that additional cash to close. Not everybody can bring an extra $8,000 to closing. So let's look at building it into the sales price, right? Monthly payment goes up about $50 a month. Cash to close goes up a little over $1,000 a month. That's working in a 2% commission. Again, the numbers do not change a whole lot in your monthly payments and in your total cash to close. And just reiterating here, if appraisal comes in back at that original sales price, we're okay. Let's keep the loan amount the same. Let's protect that interest rate there. Monthly payment's going to stay the same because we're not doing a monthly paid mortgage insurance. They're doing a single premium. Cash to close goes up about $1,000. Got it? Last breakdown here, okay? And then we're going to hit the point that everybody is concerned about more than anything else. So last one, seller pays no commissions. This is very similar to that first breakdown. $400,000 purchase, this is what it would look like. Buyer can bring that additional $12,000 to closing cash if they have that available, just to pay the 3% buyer agent commission directly, or build it into the sales price. Still 20% down, loan amount's going to go up. Monthly payment with an extra $12,000 in the sales price goes up $76 a month. And cash to close goes up, what? Not too much, about $2,000 worth. Again, if appraisal comes in back at sales price, we're okay. I hope I'm reiterating that point enough. we're okay. Appraisal comes in low, comes in back to that original sales price. Let's keep the loan amount the same. That means they're putting less than 20% down, keep their monthly payment the same, increase their cash to close a little bit, about $1,000. So there are ways to make this happen. Now, each one of these scenarios has been based off of a 20% down payment, right? Not everybody is bringing 20% down. When we look at the loans that we have done throughout this year, 85, 87% of them are first-time home buyers. Not all of them are bringing 20% down. So what we need to look at, and probably the biggest concern, is for those low down payment buyers, right? Everybody should be shaking their head. So the rule of thumb moving forward with these strategies is going to be 8% down or more. Okay, that's going to be a number that you want to write down. Anything with an 8% down payment or higher, we can work in those strategies. If appraisal comes in low, we keep the loan amount the same, we drop the amount of the down payment, and we're still able, I don't know who's writing on my screen. We're still able to 8%. It's right there. That's great. We're still able to work in that additional 3% for buyer's agent commissions. Okay. Less than 8%, that's where it gets difficult we can't just adjust the down payment because we're going to be stuck. Conventional loans with somebody buying their second house, they're not a first-time home buyer. That minimum down payment is 5%. So we don't have that 3% wiggle room to be able to lower their down payment. So in these cases, when you're talking about somebody 5% down to a 0% down loan, what do? We can't just lower their down payment because their down payment can't go any lower. So we've got to think of some alternate strategies here, right? First thing, if we can, let's adjust the sales price, add in that buyer's agent commission. That's the easiest answer here. If appraisal comes in low, now we're getting sticky, right? We don't have that flexibility to be able to drop the sales price, to be able to drop the down payment and work it in. So we have to know, we're going to have to be aggressive as far as working with appraisers and knowing what the comps are, knowing what we believe that appraised value should be, knowing that up front if we're adjusting the sales price. The second is going to be gift funds. We see gift funds fairly often where if they haven't already, or if they aren't already receiving gift funds for the purchase of that property, it might be time to ask mom and dad, ask the relative, ask the uncle, ask the rich uncle, whatever it might be, or the rich aunt. Gift funds would be a way to bridge that gap and bring that your total cash to close with those commissions included. So gift funds is going to be, it can be difficult to ask, but it's something that we see absolutely be something that comes forward from this. The next one's going to be down payment assistance, right? If somebody's putting 3% down, we can look at down payment assistance to cover that down payment, and then they're able to use the money they were going to put towards the down payment to make sure everybody gets paid here. So down payment assistance will probably see a tick up. They've saved the 3% or their 5% to put down, or the 3.5% with an FHA loan. But now instead of putting all that towards the down payment, we'll get down payment assistance to help cover that while that money they've saved is going elsewhere. The next one, this one's going to be big. This is a particular loan program we've had available, but we feel like this is going to increase in opportunity to be able to use this. What it is, it's our 1+ loan program. Okay, if you know me, you know I'm not big on programs. I'm more about service, working with the buyer, working with the listing agent, making sure everything goes super smooth. But this is a program that I feel like is going to pick up steam. What it is, it's basically a 1% down conventional loan. Okay, so the way that we work it, buyers bringing 1% for their down payment. We as a lender are crediting them that 2% back towards their down payment. And what that does is that literally frees up 2% to go towards whatever it needs to go towards. whether that's closing costs, prepaids, you can still get the seller credits there or go towards commissions. Now, the caveats to this program, it is not going to be for everybody. Think of this, it's not required for you to be a first-time home buyer, but there are some parameters around that that really stick it to first-time home buyers, where that's really the audience for it here. 620 minimum credit score. It's only for a single unit primary residence. You're not doing this on multifamily homes, on investment properties. It's strictly single family primary residence. It's a conventional loan, so we follow conventional loan guidelines. They have a reduced mortgage insurance premium. Max loan amount is going to be $350,000. So again, it's that lower price point. And probably the biggest thing here is that we've got the income limits associated with this. So with the 1+ program, it's a low to moderate census tract area. What it is any qualifying income that is 80% or less of the average median income for the area. So for Metairie, that's right at about 70,000. So if your qualifying income is 70,000 or less, then you would qualify into this program based on that income restraint. Okay, so think about it, on a $300,000 purchase, that extra 2%, that's $6,000 that they can put towards whatever they need to put it towards. Second to last one, finding a house that offers a buyer agent comp, right? So in the world we have coming our way in a week is, if a seller is not offering buyer's agent commissions, is that going to make their listing less attractive? Well, in this scenario, if somebody putting a lower down payment, it absolutely could, right? Because now they're having to find ways to finance that or to get that money for that. It might be where buyers are passing on those opportunities on those listings simply because they're not offering those commissions, and now they've got to come out of pocket for it directly, right? So we can see that shaking up things on the listing side, whether your listing is attractive or less attractive based on what's being offered from the seller side. And then last one here, I hate to bring this up, but I feel like it's one of the elephants in the room. Are you going to have buyers who simply try to go dual agency, where that dual agent's making less overall commission at the end of the day and working out that buyer's agent? Have a strong value proposition, know your worth there to be able to avoid this. But from my perspective, I'm wondering if this is something that is going to pick up in these lower down payment scenarios. So we're going to start wrapping up here. We're about, 30 minutes in. So what I want you to do, I want you to know your options. Main reason for hopping on this today, seeing those loan breakdowns, 8% down or more, you've got plenty of options there. Don't be concerned about being able to work that in. There are ways to get it done. I feel like that's where it's worth working with a lender or a financing company who has thought through this. They know the strategies to be able to help you make this happen. Not everybody has been proactive here. We're trying our best to stay proactive. Market's always changing. There's always something else coming out. So thinking through that ahead of time, I feel like maybe that's part of the MBA background, but knowing your options up front. You being here today helps in the next week, in the next month, to help make you more money over the end of the year. The commission gap coverages, we talked through those scenarios. The appraisal gap options, we talked through that. You've got strategies there to be able to make that happen, and it's not a big impact to the buyer. Last one, those low down payment solutions. Whether it's the 1+ program, it's the gift funds, or it's simply raising sales price, working in commissions that way. So what I want to do, we're about 30 minutes in. I want to open it up to questions. I see we've got a couple of questions in the chat. I'll hit those first, and then let's open it up. If you want to take yourself off mute and ask from there. Let me hit these questions in the chat. So Angela's asking about $1.
Can you hear me? Yeah.
Yeah.
So when you said the percentage and you're like, if it's between like under 10%, then they get 3%. But then you said if it's 10 to 20 or something like that, then they can get more closing costs assistance. And so my question was really based on, hey, let's say it's plus $1, right? So it's technically or plus $5 is because that would be like 10.2% or whatever. Because it says the down payment assistance, you can get 6% on conventional loans. I guess I'm talking about the seller concessions, what you have on
Yeah.
your flyer.
Yes. So let's go back to it. The seller credit limits, if you're putting 10% down or more on a conventional loan, 10 to 24.99%. That seller credit is actually 6% and not 3% that everybody's used to.
Okay. So maybe it's like 9,009. You know what I'm saying? If you let's say your person is putting down, I guess they have to, I guess there's going to be a big difference anyway. I
Yeah.
mean, they'll just put more money down to make it into the actual 10%.
Yeah, I mean, you could.
If-
That's certainly an option. I feel like normally when we
Does that
see
make
that,
sense?
they already
Sorry.
have an idea of they're putting 10% or they're putting 15% down. They know that coming in with our first
Right.
conversation. And then we need to be aware that, hey, that seller credit is actually, we can go up to 6%. We've seen a lot
Sorry
of
if that's
scenarios where, they're getting gift funds or a gift of equity where they've got 25% or more going down. And that's a huge seller credit available. I've never seen somebody get a full 9% because there's nowhere to spend 9% in closing cost and prepaids, but it's there.
Okay, thank you.
And then the other question in the chat, we'll be sending out a link. So I won't share the slides themselves, but the recording of this whole presentation we'll put that on YouTube. It'll probably be tomorrow. We'll be sending that out to everybody who joined in. So what other questions do we have?
I could start a whole conversation about all of this. Just in general, but not from the lending standpoint.
Let's stick to lending to keep it simple for today.
Okay.
What I don't want to get into is technicals as far as the y'all's contracts and buyer agent agreements. That's a conversation to have with your broker. I am by no means a legal expert there.
I guess nobody else is talking, so I'm gonna ask another question.
Yeah.
Hold on 1 second. So also on your underwriting guideline changes, you had conventional VA and FHA. So it says this, I think you said this, property sellers are permitted to make financing concessions for the borrowers between 2 and 9%. Does that include broker commissions? Because I thought you said yes, but then when you look at the VA and you were saying that's just like a much better, they're being a little more proactive. Does that mean they can't pay it on the conventional or?
So on conventional, it's always been customary for the sellers to pay the buyer's agent commission. Still totally fine. Nothing changes there. That is not a part of those 3, 6, 9% seller credits. That is separate.
So you can't add that in then. You can't say 3%. I mean, technically, yeah. I mean, you just up the price but
Right.
For lender guidelines, you can't say, please pay, 3% and then the next 3% is going to go towards the buyer brokerage agreement. You can't say that. You would have to increase your costs, ask for 6%. Let's just say.
Well, it depends on which side it's coming from. So if it's coming from the buyer side, we've already had situations where like the seller's crediting towards closing costs, prepaids, and a portion of the commissions. And then we have that buyer's agent agreement part of the contract where they're getting the full 3%, the buyer simply bringing those additional funds. So you can work it in either way.
So basically they have to come to the table with money. On top
Once
of,
you work it into the sales price,
and ask the seller to pay all of it.
correct.
Okay. I'm just. Yeah. Is this only for actual realtors, or what about real estate agents if they're not part of NAR? Like, let's say somebody just decided not to be a quote unquote realtor anymore. Do all of these things apply to that? Because you don't have to be a realtor to be a real estate agent.
You know, I cannot answer that question. From the
Okay.
financing side, that wouldn't change anything for us.
Okay.
From the represented side, whether you're with NAR, not with NAR, I couldn't answer that.
I hope somebody else asks a question. I feel like I'm the only one asking.
And so thoughts on, we understand the 8% rule of thumb, low down payments. Let me get some feedback there. What is everybody thinking in that market? As far as whether it's gift funds, whether it's changing loan programs. I don't know if y'all have seen this start to happen in the markets already. Give me some feedback there, then we'll wrap this up.
I guess. Let me ask you, is this legal? I don't even know. Can they get a first loan through the seller and a second loan through the bank?
So there's all types of creative financing,
Okay.
whether, maybe it's a 401k loan. We'll see people do that for down payments. There's no reason they couldn't take money from their 401 to cover commissions. Now, it's not customary in America as far as any other industry I can think of for somebody to finance commissions separate from the actual transaction itself. It's certainly an
Well,
option.
I guess I wasn't thinking of financing it. I was thinking more along the lines of, I don't know, I can do a separate phone call and pick your brain. I
Yeah.
don't have to.
There's
into, like,
that's where you
every
get
thought.
creative.
Yeah.
As far as we've seen, there's no like second mortgage or anything associated with specific to commissions. But that's where either an unsecured line of credit or a loan against assets, a 401k loan, whatever it might be, or a personal loan from family, whatever it is, if that is what they needed to do to make it happen, I
I've
feel like
never heard of
that would be a solution.
401k loan from asset. Is there like you can pull it out of your 401k and not get penalized or something, or what is that?
You're basically taking a loan against your 401k, then paying yourself back.
But you don't get penalized for, there's like, is it zero interest or do you get?
It depends,
Mhm.
each asset holder is going to handle that differently. So I think what we'll do, let's go ahead, let's wrap this up. Hopefully this was helpful, just seeing numbers, seeing breakdowns, the different options that are out there. As far as buyer's aptitude, that'll make a little bit of a difference, but know that, there are solutions out there, ways to get this done. So everybody has my contact information at this point. If you haven't, one last chance to scan. But any questions, if we need to talk any details or any specific situations, I'm always around, here to help. You've got my cell phone number right there and happy to help. So hope this was helpful. Thanks everyone for jumping on. Had good attendance here today, and see y'all on the flip side.